Imagine the following situation. A beginner trader feels very happy because he is living through a bull market. He sees his portfolio growing week after week. Time passes. One day he watches a video where an old and famous investor says that a crisis is imminent because the market is too stretched and fundamental indicators are flashing warning signs. Prudent but inexperienced, the beginner trader starts looking for what he can do to try to protect what he has already built. Then he listens to another investor, even older and even more famous than the first one, talking about how companies with a competitive advantage and a strong brand can protect him during crises. And that is how the trader finds the stock of a traditional beverage company that has everything the older investor defends: a solid brand and good fundamentals. So the beginner takes profit from the hyped companies he owns in his portfolio and buys a large amount of shares in the traditional beverage company, believing that when the crisis mentioned by the famous investor finally arrives, he will be protected and will keep making money while the world around him falls into ruin. Many months go by, but the crisis finally arrives. The beverage company holds up a little at first, but as panic starts taking over investors and people begin closing their positions all at once, he realizes that the traditional beverage company also suffers a violent decline. Afraid of watching the money he had made during the bullish market disappear, he closes his positions as soon as his current year P&L reaches zero. One single bad decision cost him months of work. The beverage company was good and continued making money, but the beginner sold because the selling pressure, the big red bar on the chart, was too strong for him to handle. After all, he had convinced himself that the company would be able to carry him through the crisis and spare him from the pain. Today I want to talk to you about defensive companies and sector rotation strategies so that you know exactly what you are dealing with. I'm Ferruccio. I've been a swing trader for about 8 years. What are defensive stocks? They are stocks of businesses with relatively stable demand, businesses that are able to maintain profit margins even during periods of inflation and recession. Basically, they are stocks of businesses that people cannot live without, and because of that, customers tend to accept price increases caused by inflation. They are almost always inside what we call the defensive sectors of the economy, which are three: consumer staples, which refers to companies that sell food, beverages, personal hygiene products, and household goods; healthcare, medicines, hospitals, and medical treatments; and utilities, generation, transmission, and distribution of electricity, gas, and water, excluding the mining of fossil fuels and uranium. These sectors are highly important for sector rotation strategies. What are sector rotation strategies? They are strategies that rotate capital between sectors of the economy, following a model based on valuation, momentum, or relative strength. Let me give you an example. Imagine a portfolio composed of 5 stocks, one from the technology sector, one from the industrial sector, one from consumer staples, one from utilities, and one from healthcare. Each one of these companies initially represents 20% of the strategy's portfolio. Then a bullish market comes, and people start buying more technology stocks, both because of the hype and because these companies are delivering good reports. Positive expectations from analysts mix with euphoria, and the price of stock A starts rising a lot while the other stocks are left behind. The S&P 500 rises as technology stocks become a larger percentage of the index, but staples and utility stocks, which are not as attractive, are left behind. A sector rotation strategy based on momentum or relative strength will still keep buying stock A from the technology sector while the buying pressure continues. However, as soon as the model indicates that the buying strength in that sector is fading, it will take profits and reinvest its capital into the sectors that the model says are relatively cheap, in this case C and D. If everything works out for the strategy, and if the model works as expected, which is not guaranteed, the result will be a larger amount of equity and growth in the portfolio. These strategies are attractive to investors because they promise diversification. They generate comfort and a sense of protection because they are exposed to the defensive sectors of the economy. And this is a trap that the beginner investor or swing trader does not notice right away. I'll explain it very soon. In this chart, we have the price of the XLV ETF, which is the ETF that contains the healthcare companies of the S&P 500, divided by SPY, which is the largest ETF that tracks the index. The crisis periods are marked on the chart by the dark red areas. As you can see, during these crisis periods, healthcare companies did in fact outperform the broad index. This also happens with companies from the other defensive sectors. XLU represents companies from the utilities sector, and XLP represents companies from the consumer staples sector. All three outperform the S&P 500 during crisis periods. Outperform the S&P 500. Did you notice the trap? I said these companies may perform better than the S&P 500 during crisis periods, not that they are immune to falling. The truth is that they can also fall in price, just probably less. To prove to you that this does not happen only in the US stock market, now I have also put on the screen ETFs of the largest global companies. In the blue line, XLV, US healthcare stocks. In the white line, SPY. In the green line, IOO, which is the ETF of the 100 largest global companies. And in the orange line, IXJ, which is the ETF of the largest healthcare companies, also at a global level. Notice how the price action, the movement of price, is similar for these four ETFs, especially during crisis periods. Here is a closer zoom into two crisis periods, the dot-com bubble on the left and the subprime crisis on the right. Look at how similar the price movements are. This is also true for the other defensive sectors. Here now are the ETFs of utility companies in the US and at a global level. And now for the consumer staples sector. Just by looking at the price action, you can already see that the so-called defensive sectors actually have a significant correlation with the stock market as a whole. Therefore, they do not offer all the diversification and protection that many people think they do. But suppose I had not shown you each of these sectors at a global level. These are now some of the main investment funds that use sector rotation strategies. In white, I keep SPY, and in the other colors, the funds. Notice that even institutional players, if they remain exposed to stocks at all times, even if they are rotating capital between sectors, are still subject to broad market risk. In fact, once we include each fund's fees, they have performed worse than SPY since 2019, with lower risk-adjusted returns. In conclusion, it is possible to make money with sector rotation strategies, but you cannot fully escape broad market risk if you remain long stocks all the time, even when rotating into defensive sectors. A simple buy and hold approach will leave your portfolio fully exposed to the impact of major market drawdowns. There are many ways to make money in the financial market. For me, what makes the most sense is to gradually build a portfolio of robust algorithmic strategies. That way, you use models to help you enter and exit assets at moments when you have a statistical edge instead of staying exposed to market risk all the time. I hope this video gave you some value. If it did, please drop a like and consider subscribing. Tell me in the comments if you prefer that in the next video I talk more about how to create an algorithmic strategy, or if you prefer that I keep talking about conceptual topics. Thank you for watching until the end. I'll see you in the next one. Ciao.